Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 650 videos with more than 300,000 watch hours as of December 2024. Today, we're diving deep into Mapletree Logistics Trust's latest quarterly results. MLT is one of Asia's largest logistics REITs, and their recent numbers tell an interesting story of resilience amid challenges. Let's break down what's happening and what it means for investors. The numbers paint an interesting picture this quarter. Revenue and NPI are showing slight dips. We're looking at 182.4 meters in gross revenue, down 0.9%, and 157.2 meters in NPI, down 1.4% year over year. The DPU took a more noticeable hit, dropping 11.1% to 2.003 cents, which naturally catches my attention as an income-focused investor. On the brighter side, the trust is maintaining solid operational metrics. The portfolio occupancy stands strong at 96.3%, and they're achieving positive rental reversions of 3.4% overall. What's particularly interesting is that when we exclude China, that rental reversion jumps to 5.4%, suggesting stronger performance in other markets. The capital management looks pretty stable too. The aggregate leverage of 40.3% gives them some breathing room, and with 82% of debt hedged to fixed rates, they're well protected against interest rate volatility. The average debt maturity of 3.5 years and 76% of income hedged for the next 12 months adds another layer of stability. What really catches my eye is their active portfolio rejuvenation strategy. They're divesting properties across Asia, in China, Japan, and Singapore, and all above valuation. The standout deal is One Genting Lane in Singapore, sold at a whopping 35.2% above valuation. Post-quarter, they've announced more divestments in Malaysia and Singapore, also at premium valuations. This strategic reshuffling suggests MLT is taking advantage of market opportunities to optimize their portfolio, though we'll need to see where they redeploy this capital. Let's move on to the next slide to dig deeper into how these changes are impacting their overall performance. All right, folks. Let's dive into the year-on-year numbers, which really helps explain those headline figures we saw in the first slide. The revenue decline we talked about earlier becomes clearer when we look at the details. The main pressure points are coming from China, along with the impact of divested properties and some currency headwinds, particularly from the Korean won, Hong Kong dollar, and Japanese yen. The good news is that Singapore, Australia, and Hong Kong SR are picking up some of the slack, helped by recent acquisitions. MLT's hedging strategy is also doing its job, softening the blow from currency fluctuations. The cost side tells an interesting story too. Property expenses crept up by 2.8% to $25.2 million, mainly due to higher utility costs, property taxes, and expenses from new acquisitions. But here's where it gets interesting. Borrowing costs jumped 8.7% to $39.9 million. This increase reflects both higher interest rates on existing debt and new borrowings for recent acquisitions, though they've managed to offset some of this through smart use of divestment proceeds. Looking at the bottom line, the amount distributable to unit holders fell 9.7% to $101.3 million, leading to that DPU decrease we saw earlier. When we strip out divestment gains, the adjusted DPU comes in at 1.855 cents, down 7.5% from last year. However, it's worth noting that on a constant currency basis, gross revenue would have actually increased by 0.6%, and NPI would have held steady. The total number of properties in the portfolio has decreased slightly from 186 to 183, showing MLT's active portfolio management strategy in action. This ties back to those divestments we discussed earlier, suggesting a quality over quantity approach. Let's move on to the next slide to see how these financial results translate into MLT's broader market positioning and strategy. Now let's talk about MLT's debt situation, which is particularly relevant given the higher interest rate environment we discussed earlier. The debt maturity profile looks well structured, with a healthy spread across different years. What catches my eye is that only 12% of total debt, about 699 million, needs refinancing in FY25-26, which gives us some comfort about near-term financial flexibility. The trust has spread out its debt obligations nicely, with no single year taking on an overwhelming portion, the highest being 20% in FY26-27. The currency breakdown of their debt profile is fascinating and shows smart treasury management. The largest exposure is to JPY at 28%, followed by RMB at 21%, which aligns with their significant presence in Japan and China. SGD exposure at 15% provides a stable base, while the rest is diversified across various Asian currencies. This natural currency hedge helps protect against some of the forex volatility we saw impacting their revenue. What's particularly reassuring is the $821 million in available committed credit facilities. This gives MLT plenty of breathing room for both refinancing needs and potential opportunities. The average debt duration of 3.5 years also provides good visibility on financing costs, especially important when we consider the interest rate pressures we saw in the earlier financial numbers. The mix of financing instruments, term loans, medium-term notes, and revolving credit facilities shows a sophisticated approach to debt management. They're not putting all their eggs in one basket, which helps optimize financing costs and maintain flexibility. All right, let's talk about the upcoming distribution details, which is always a key focus for income investors like us. For 3Q FY24 to 25, MLT will be paying out 2.003 cents per unit, which ties back to the lower DPU we discussed earlier. The distribution period covers October through December 2024, and here's something timely. The ex-date is just around the corner on January 28th, 2025. With the record date following on January 31st, 2025. For investors looking to qualify for this distribution, you've got just a few days left to get in before the ex-date. The payment date is set for March 13th, 2025, which follows MLT's typical timeline for distributions. While the DPU is lower than last year, it's worth remembering this in the context of those strategic divestments and the challenging interest rate environment we discussed earlier. The trust is still maintaining its distribution policy despite the headwinds, which speaks to the resilience of their underlying portfolio. The timing of these distributions aligns with MLT's quarterly payment schedule, providing regular income streams to unit holders. This consistency in distribution scheduling, even amid portfolio restructuring and market challenges, demonstrates MLT's commitment to maintaining predictable returns for investors. Now let's dive into MLT's geographical diversification, which really helps explain the portfolio's resilience we've been discussing. The trust has built an impressive footprint across Asia Pacific, with total assets under management hitting $13.4 billion. What's particularly striking is how they've balanced their exposure between developed and emerging markets. About 70% of both AUM and revenue comes from developed markets, which provides that crucial stability we want to see, especially during uncertain times. Singapore leads the pack in both metrics, contributing 19.9% of AUM and an even more impressive 27.5% of gross revenue. Hong Kong SAR follows as the second largest market by AUM at 23.2%, though it accounts for a smaller 16.8% of revenue. China represents another significant chunk at 18.5% of AUM and 17.4% of revenue, which explains why those earlier China headwinds had a noticeable impact on overall performance. What I find particularly smart about this distribution is how it creates natural hedges against regional risks. If one market faces challenges, like what we're seeing in China, the others can help cushion the impact. The mix of mature markets like Singapore, Japan, and Australia, alongside growth markets like Vietnam and India, offers both stability and growth potential. This geographical spread also ties back to that debt profile we just looked at. The currency exposure in their borrowings largely matches their asset distribution, creating a natural hedge against currency fluctuations. It's this kind of thoughtful portfolio construction that helps explain why MLT has been able to maintain its distributions despite various market challenges. Now let's look at MLT's portfolio snapshot, which gives us a great bird's eye view of their operations and ties together many of the points we've discussed. The trust's $13.4 billion in assets under management is spread across a robust portfolio of 183 properties serving 950 tenants. That's a healthy tenant base, providing good income diversification. The occupancy rate stands strong at 96.3%, which is particularly impressive given the challenging market conditions we discussed earlier. The weighted average lease expiry, WAL, of 2.7 years offers decent visibility on future income, though it's worth keeping an eye on upcoming lease renewals. Looking at the geographical breakdown, Singapore leads with 47 properties, followed closely by China with 42. This explains the significant impact of Chinese market conditions on their performance that we noted earlier. What's interesting is how Hong Kong SAR, despite having only 9 properties, contributes substantially to revenue and AUM, as we saw in the previous slide, suggesting these are high-value assets in prime locations. The portfolio mix shows a nice balance between established markets, Singapore, Japan, Australia, and growth markets, Vietnam, India. With 8.2 million square meters of net lettable area, they've got significant scale across these markets. Japan's 22 properties and South Korea's 21 properties provide exposure to mature logistics markets, while the 12 properties in Vietnam and 3 in India offer growth potential in emerging markets. This diverse property spread aligns well with their capital management strategy we discussed earlier, particularly in how they've matched their debt exposure to their asset location. The recent divestments we talked about earlier are part of their ongoing portfolio optimization, showing they're not just collecting properties, but actively managing them for better returns. And finally, let's wrap up with MLT's outlook, which really ties together everything we've discussed and gives us a clear picture of what's ahead. The macro environment looks pretty challenging, with several headwinds on the horizon. We're seeing growing uncertainty from geopolitical conflicts and trade tensions. Plus, the U.S. Federal Reserve might not cut rates as quickly as initially hoped. These factors could squeeze demand for logistics space across Asia, which explains some of the cautious undertones in MLT's strategy. The China situation deserves special attention. The management team is keeping a close eye on Trump administration trade policies and their ripple effects on international logistics. They're also watching how China's government stimulus measures might help boost economic activity. This ties back to those weaker China numbers we saw earlier, and the negative rental reversions there are expected to continue. Though remember, the portfolio is showing resilience overall with positive rental reversions when we exclude China. The financial headwinds we discussed earlier, namely the strong Singapore dollar and higher borrowing costs, continue to impact results. However, MLT's management has a clear game plan with 4 key focus areas. They're pushing ahead with portfolio rejuvenation through strategic acquisitions and divestments, which we saw in action this quarter, actively managing their assets and leases, maintaining disciplined capital management, reflected in their well-structured debt profile, and advancing green initiatives for a low-carbon future. This balanced approach to managing both current challenges and future opportunities gives us a good framework for evaluating MLT's performance in the coming quarters. While near-term headwinds persist, the Trust's strategic focus on portfolio optimization and financial discipline suggests they're well-positioned to navigate through this challenging period. MLT presents an interesting investment case. Despite near-term headwinds, their strategic focus on portfolio optimization and financial discipline positions them well for the long term. The Trust's diversified portfolio and proactive management approach provide resilience, while their presence in both developed and emerging markets offers a balance of stability and growth potential. For investors considering MLT, the current challenges might present an opportunity to gain exposure to Asia's logistics sector at a more attractive valuation. However, keep in mind that the China situation and interest rate environment will likely continue to impact performance in the near term. That's my take on MLT's latest results. Remember to do your own research before making any investment decisions. If you found this analysis helpful, don't forget to like, subscribe, and hit that notification bell to stay updated on more REITs analyses. Thanks for watching, and I'll see you in the next video.